What's going on, everybody? It's Jeff here. What a dynamite day today. AMC was up about 5%. We had two monster plays that I called out in the group pre-market that a lot of people had banked on. I'm going to go over exactly what they are and what I specifically saw in them. I also want to talk about another catalyst that could be very positive for us who hold AMC in the short term, but it will definitely be positive for us as investors going on in the future. It is another rule filing that finally got its Federal Register. We're going to talk a little bit about that. Let's get right into it. I want to take a quick look at AMC chart right here. It popped out of the gate, and at 10 o'clock, it had a little bit of a pullback, which is normal when it does pop really hard out of the gate. However, there wasn't really any stagnation around that $31 level. There was no additional shorting. It immediately just popped all the way up. Nice solid uptrend to about that 34.10 level. Right around when power hour started, looked like it was going to consolidate, ready for another rip. Probably a little bit of profit taking going on in there by the day traders, which is natural. But like I said, from that $31 level all the way up, 3 full points, coming back down just 1 point is still great. We're looking like we're going to close about between 4 and 4.5% for the day. I do want to mention this as well. This is the SPY. It hit another all-time high. SPY is an S&P 500 ETF for those of you that are unaware. 445. As much as I have said numerous times to everybody that we are seeing another frothiness, a little bit of overextension in the S&P, you can see right here it continues to crawl up, bounce off the 50 moving average, crawl up a little bit. The pattern is beautifully written right there, and you can see we're getting to that point. There's two things I've learned from investing. Don't fight the tape and don't fight the Fed. And right now, the tape is green, green, green. Continue to ride it, looking for some of those blue chip stocks that follow very, very closely to the S&P. And as soon as you see that next high not being made, that's when you can switch your positions, see the S&P is going to pull back, and you know pretty much exactly where it is going down to this 50 moving average, which it has hit, 1, 2, 3, 4, 5, 6, 7 times previously, and this is only the daily chart. So the two plays that I called out about 8 of them earlier. If you're interested in joining our private community, first link in the description. With 2 plays, 2 out of the 8 plays I called out, I really want to notably say this one was right here. This one was Palantir. I had said early on pre-market around 9 o'clock that you can see it failed to really breach above that 24.50, but there was a large increase from yesterday, from 22 market close all the way up to 24.50. When it fails to make the news highs, just like Clove did this morning, as soon as market open, that's a market flush, there's profit taking right away. It happens all the time. Waited for the bottom, called it out, told everybody to be patient, wait for that little bit of consolidation, ripped all the way back up to about 25.75. That was an 8% banger that you could have rode all the way up. The other one I want to talk about is Moderna. Called this one out very well. We've been playing this one for the last few days. It reached that 500, almost 500, 498, but that 500 point got a little frothy, especially because it's run insanely hard. We played it both ways on a couple days ago, and then coming into yesterday right here, it was some nice shorting all the way down to 372. Expected it to be overextended. It started out of the gate a little bit higher, and what happens, like I just said with Palantir, it opens up higher. This is that market open flush. There's profit taking right away as soon as it bottomed out, able to catch a little scalp going up. Whether you're playing stocks, you're playing options, either way, this was a phenomenal trade for many, many of us inside the group. There is another one, as it did get frothy down here. A couple people had messaged me saying that they played this. Unfortunately, I was getting my hair cut, so I missed that intraday, but that was a really, really good play. That's it, guys. Let me get into now what I wanted to talk about, which was the latest rule filing. It is NSCC 2021-005. As you can see, the federal released for August 11th. There was one amendment, as you can see on here, to this, all right, the increase the National Securities Clearing Corporation's minimum required fund deposit. I covered this probably like 100 videos ago. It's been a long time since this was first, passed around for approval, and it's finally going to be finally got approved by the Federal Register. But if you don't remember what it was increasing the minimum required fund deposit from $10,000 to 250,000. That is a 25 times gain, okay? And they did a little bit of back testing over the past few months to see what the right number exactly was, because a 25x is huge, and they found it to be pretty accurate with 99% efficiency. So what does this exactly mean? Well, there's two parts to it. One, it means that these hedge funds, these institutions, they have to have enough capital behind them to be able to be approved for margin, for funds to be lent out, and for positions to be taken. So you don't run into an issue like we ran into in 2008. Bring this back for a long time just to say all of these filings are there to protect the market from an insane crash. No matter what happens, they need to think about the market first, because they do not want another 2008 happening again. That's the first part to it. It's raising liquidity. So what could happen from that? They might have to sell out on some of their long positions. They might have to close out on some of their short positions, and so forth. Look at this also to affect the very, very small, individuals, the small little guys first, before getting into the bigger guys. It's probably going to knock off a few of the small ones like Archegos, happened, and so forth, before we can get up to the bigger ones. All right, so just keep that in mind. This second factor to this is they're trying to take the human element out of this. Meaning, if you go to buy a car and you cannot get approved at the big time dealership because your credit is horrible, but a local salesman, or a local car dealer, okay, or a lender, or whatever you want to say, and you say, can you turn a blind eye because you know me? I'm good for it. I can make the payments. It doesn't matter what the paper says, I can make the payments. And that's what happened. Deals are made because of personal relationships. This basically automatic quick margin requirements and margin calls are trying to take the human element out of it. Why? Because the SEC has seen clearly that these relationships, in order to benefit each other, which when you benefit each other, it's a disservice to a large majority, okay, of everybody else. And that's exactly what they're trying to get rid of. It's that human element. So I'll be really, really keen to see how this goes forward, for the next, month or so. But like I said, whether this has a direct, quick impact, like I know some of us want, it's very beneficial to us for going forward in the future. And we are slowly starting to spread that vast gap of difference between the large institutions and us as the little retail investors. So that's it for this video, guys. I'll see you in the next one.